We have seen a jump in stocks this morning, but of course, generally the TSX has been well ahead of the US market this year. Our guest is watching closely how Canadian companies will perform versus US names this earnings season. We're joined by Chhad Aul, Chief Investment Officer and Head of Multi-Asset Solutions at Sun Life's SLGI Asset Management. Great to see you, Chhad.
Great to be here.
First off, though, could you talk about this rally we've seen in stocks today? Apparently, investors delighted that the trade war between the US and China is on hold for now.
Absolutely. And I think, late last night we had heard, first of all, just substantial progress without much detail. So we, like others, were waiting for some of those details. And I think when they came out, as we hit morning time in Europe, probably much better than I think what most would have expected, right? Dialing things back to kind of that baseline 10%, plus, of course, the fentanyl-related tariffs was more than I think most would have expected for the next 90 days. And investors, of course, cheerful. Now, we've heard a lot, of course, that we're still at a tariff level that's higher than we were the last time the markets were sitting at these levels, and getting back to almost flat for the year for U.S. markets. But for now, the direction of travel is up, and the momentum is there. And as I say, don't fight the tape.
That's interesting. You think it could be, obviously it's hazardous, but you think this could be a turning point for the markets, maybe?
I think in the near term, maybe we're in a little bit of an eye of the storm sort of scenario, with the 90-day pause. I think, it gives an opportunity for even policymakers to shift to potentially more positive areas, such as the tax cuts, et cetera, that could drive markets, further. And I think what may take before markets may settle down a little bit is if we begin to see the economic data come in, begin to see the impact of, again, tariffs that have been in place, continue to be in place at a higher level than where we were at the beginning of the year, see how those are affecting, obviously, prices, how those are affecting economic growth. That's going to be the real test for the markets. But again, in the near term, we're mostly driving on sentiment at this point. So the path of least resistance is higher.
But as you note, we're in a tariff regime that tariffs are much higher than when equities were near this level previously. And you're also watching the US dollar. Maybe we could put up a year to date for that, because you say we've yet to see a significant recovery for the US currency.
Right. And that is one of the things that really shifted once we got, a little bit more clarity this morning, right? So currency markets were taking a bit more of a wait-and-see approach, and generally have been, compared to equity markets, which of course have been rallying quite a bit since around April 10th or so. The dollar has had a couple of rallies. Today is certainly a big one. So that's one we're watching, where we think the currency markets are being a little bit more careful to assess economic impacts. But certainly the rally today in the US dollar against most other pairs, again, been down a fair bit this year, reflects that this is a pretty big step back, probably more than most would have expected.
On the tariffs.
On the tariffs. Takes kind of the most extreme scenarios off the table, I think. We have a better sense. So a bit more clarity, I think, is ultimately what I think investors are sussing out here, is that, that 10% baseline is probably, at the end of the day, where we're going to land as when you think about how the administration's looking at tariffs as a revenue generator. It's that kind of 10% level is probably answers the revenue side of the equation. And any other negotiations therein on these reciprocal components are more about affecting that bilateral trade deficit. So if it's a 10% kind of outcome over the long term, that's something that I think markets can digest, right? It's ultimately more of a tax, think of it like a consumption tax within the U.S. And that's something that, again, markets can deal with. We don't know where we're going to go from here. Certainly lots of, like I said, lots of uncertainty still. But for now, markets are happy that the worst is off the table.
Do you think there has been a genuine flight from U.S. assets?
I think to a certain degree, the fact that you've seen U.S. assets weaker than other markets, so whether it's the stock market year to date in the U.S., U.S. Treasuries, and then at the same time the U.S. dollar has generally been falling, and the U.S. dollar has been more or less correlated with those U.S. assets. It does feel like there is a reallocation happening, and I think that still may occur over the longer term. So one of the things is we still think it makes a lot of sense to be globally diversified in your equity allocation. It's helped this year after a number of years where all that mattered is just piling into the U.S. stock market, right? You couldn't go wrong as an investor.
Yeah.
And we've always advocated for a more diversified approach. We've seen that's been beneficial so far this year. Absent today, of course, a nice catch up for U.S. assets. But I think that it is an approach that will continue to be beneficial as the uncertainty is still there in terms of where we're going to land on tariffs and what the ultimate impact, even of where we sit today, will be on the economy.
And the S&P, as of today, now down only 1% for the year. The Nasdaq down only 4%. Our market up about 3.3%.
That's right.
We've heard suggestions that the Trump administration really wants a lower U.S. dollar, partly as a competitive devaluation to boost U.S. exports. Right. What would be the implications of that if the U.S. dollar does stay weak?
I mean, it probably was a little bit overvalued, to be perfectly honest, coming into this year, which creates, again, some more space for devaluation or to remain lower, even if U.S. assets like the stock market are rallying, right? So it's more about, and again, that makes sense in the broader objectives around trade, but it's the sort of, let's call it, not very well handled or a very precipitous decline is something I think they would want to avoid in the U.S. dollar as well, right? So I think they although they're going to always talk about wanting a stronger dollar, happy to have it lower, again, as long as it's being managed fairly well in terms of how that drawdown happens, again, because it does help with that, as you mentioned, rebalancing the trade.
Chhad, thanks very much indeed.
Great to be here.
Chhad Aul, Chief Investment Officer and Head of Multi-Asset Solutions at Sun Life's SLGI Asset Management.